Basically, it is better you understand what you are going to sign at the end of the audit process and what kind of assertions you are making in the audit report, including the auditor's responsibility, which would help you in understanding other requirements of the auditing standards, which our other eminent speaker will take up in the subsequent session. I would like to thank WRC for taking such an important topic, which is standard on auditing, because it is very important in the current environment whereby the auditor itself are subject to audit by the regulators, and the auditors themselves are required to demonstrate that they carried out audit in accordance with the requirements of the standards of auditing, which is like governing regulations for the audit fraternity, and they need to also document that during performance of the audit they exercise adequate diligence, due care and professional skepticism, and also evidence that by way of basically their working paper. So section 700 series deals with audit conclusion and reporting standards. There are 6 standards under this series, out of which we will cover in today's my session 3 standards, which is SA 700, 705 and 706. However, I will very briefly touch upon requirements of other 3 reporting standards as well. These are very complex auditing standards. I tried to make them as easy as possible to understand and bring lot of practical aspects in my discussions and presentations. I would go little slow. I think the session was from 10 to 11:30, but I think even 1 hour is more than sufficient for me to cover key aspects of these 3 standards. So SA 700 basically deals with how to form an opinion on the audit of financial statements, and what could be the format and the content of the audit report. Typically it deals with unmodified opinion, or we may call it in a layman language, it's a clean opinion on the financial statements, whereas SA 705 and 706 deals with basically how the form and content of the audit report may get impacted when auditor decides to issue unmodified opinion or include emphasis of matter or other matter paragraph, which is governed by SA 705 and 706. SA 701 deals with auditor's responsibilities to communicate key audit matters in the auditor's report. This is mainly, this requirement is applicable to listed entities. If I may briefly touch upon what is key audit matters. So key audit matters are the matters which require significant auditor's attentions, especially considering the areas which involve high risk of material misstatements or significant risk of material misstatements, including areas which include significant management judgments and accounting estimates, or that could be also the areas whereby events or transactions that have occurred during the current period which may have impact and bearing on the audit. So if those are, if there are similar such kind of matters, then the auditors are required to include key audit matters in the audit report, explaining why they believe these are the key audit matters and what procedures auditors have performed to basically while performing the audit on those areas. When prior period financial statements are audited by predecessor auditors are unaudited, then the requirements of SA 710 applies. SA 720 basically requires the auditors to read and consider other information which is included in the annual report, because the other information which is included in the annual report, in which also the financial statements and auditors reports are included, if there are any inconsistencies between other information and the financial statements, then it could be an indicator that either the financial statements are misstated or there is a misstatements in the other information. In both the scenario, it actually diminishes the reliability of the financial statements as well as an auditor's report. Here I have tried to basically capture the entire audit process into four stages. So stage number 1 is initial planning, which I know maybe we are going to cover in the last. Second piece is developing audit plan, and third piece is performing audit plan, and the fourth piece is concluding and reporting. So concluding and reporting is the last stage which we are taking up in the beginning of program on standards of auditing. Initial planning would include risk assessment, establishing terms of engagement and agreeing the terms of engagement with the management and those charged with governance, understanding the business and environments including the internal control framework, determining materiality. In this second stage, it will be developing audit plan, which would include preliminary analytical procedures to identify which are the account balances which are material from the financial statements perspective, and devising a strategy to carry out test of control and substantive procedures. In the third stage, the auditor would actually execute the audit engagement and carry out test of control and substantive procedures. And in the last stage, that once we complete our audit procedures, the auditor would basically review the financial statement to see that whether the financial statements prepared is in accordance with requirements of the reporting framework, perform subsequent event review, which I think we would take up in the next session, obtaining management representation, read other information as per SS 720, which I just spoke in my previous slide, and then concluding and reporting. So let us understand what is the scope of SA 700, what is in the scope of SA 700, what is not in the scope of SA 700. So as I said that SA 700 deals with responsibility of the auditors to form an opinion on the financial statements and also form and content of the audit report. SA 700 deals with complete set of general purpose financial statements. Now what is the general purpose financial statements? So general purpose financial statements are the financial statements which are prepared in accordance with financial reporting framework, which cater to the needs, common needs of wide range of users, and hence it is called a general purpose financial statement, which is prepared under general purpose financial framework. If the financial statements are prepared under special purpose framework, then SA 800 would apply, and SA 805 deals with not the complete set of financial statements but maybe a single set of financial statements or a specific account balance, then SA 805 will apply. When we talk about general purpose financial reporting framework, so there could be two type of framework. One, it could be a fair presentations framework, another could be it's a compliance framework. Now what is the difference between fair presentation framework and compliance basically framework? So fair presentation framework goes one step beyond compliance framework. So fair presentations framework not only require compliance with the reporting framework, but it also basically many times there are certain situations whereby the management need to give disclosure beyond what is required under reporting framework. So it could be a situation whereby there are certain situations which is though not mandatorily required by, for example, accounting standard to make a disclosure, but to give a fair presentation, maybe those disclosures are needed. And in extremely rare circumstances, it may happen that if you follow the framework, maybe the account may not give true and fair view. So in that case, it may also require to depart from the requirements of reporting framework. Though such situations are very, very rare, but those situations may arise whereby the management need to depart from what is specified in the accounting standard. Globally, there are very, very rare circumstances where basically this provision got triggered, whereby the management believed that by following the accounting standards or reporting framework, the account may not give true and fair view. So generally, the reporting framework is aligned with basically to give a true and fair view, but there could be a circumstances where it may not give true and fair view, and that's why the fair presentation framework require the management to depart from the guidelines which is laid down in a particular framework. Whereas compliance framework is like whatever is given in the framework has to be followed blindly, and that's why the reporting, the manner of reporting differs. When you give report under compliance framework, when you issue a report under fair presentation framework, normally audit under Companies Act is a fair presentation framework, whereas maybe if you look at the audit report which is issued for public trust account, whereby you have to only ensure that the financial statements are prepared in compliance with the guidelines which has been set. As I said that SS 700 deals with how to form an basically opinion. So it also give a guidelines that before you issue your opinion on the financial statements, what all things which you need to conclude and evaluate, and then you reach to a conclusion that basically what kind of opinion you are planning to issue. So first of all, you need to see whether the auditors have obtained all the sufficient appropriate audit evidence. Auditor is required to evaluate if there are misstatements which have been identified during performance of the audit, whether those uncorrected misstatement is material or not. And while doing that, even the auditor will have to basically keep it in mind that whether management is biased in forming their judgment. So if I may give you an example, that auditors have identified means lot of misstatements in the financial statements, and the auditor goes and discuss with the management, and the management is basically correcting those misstatements very selectively. So they are only giving effect of the item which increases the profit, and they are ignoring the items which actually decreases the profit. So the management should be mindful about basically is there a management bias in preparation of the financial statements. Now let us understand what kind of misstatements can arise. So the misstatements could be that the accounting policies which are selected by the management may not be in accordance with the requirements of reporting framework. So that is not consistent in as per the applicable accounting standards. So wrong accounting policies have been selected. It could be that okay, the accounting policy which is selected and disclosed in the financial statements, it is in line with the reporting framework, it is in accordance with the accounting standard, but those policies have not been applied correctly in preparation of the financial statements. Then also there is a misstatement. Misstatement could also arise if there is a misstatements in the disclosure. The disclosure is not in line with the requirements of the accounting standard, then also there is a misstatement. Or as I said that in the fair presentation framework, where the management needs to disclose beyond what is required under the accounting standards. So even those disclosures, if it is missing, then also it is considered as a misstatements in the financial statements. And after considering all this aspect, the management needs, the auditor needs to form an opinion whether the financial statements are prepared in all material respect in accordance with the applicable financial reporting framework, and then the auditor, if it is satisfied, they can issue an unmodified opinion on the financial statements. Now let us look at the requirements of SA 705. There could be a circumstances whereby the form and content of the audit report may get impacted. So as we said that in the previous slide, the auditor need to assess whether the auditor has obtained sufficient appropriate audit evidence. If say suppose answer is yes, the auditor has obtained sufficient appropriate audit evidence, then the auditor need to evaluate whether there are misstatements in the financial statements, and the auditor conclude yes, there are misstatements in the financial statements. Then the auditor need to evaluate whether those misstatements are material, and if those misstatements are material, then the auditor is required to modify the opinion. Now let us start from the beginning. If the auditors have not obtained sufficient appropriate audit evidence, then the management, the auditor needs to evaluate whether basically those lack of evidence is expected to give rise to material misstatement in the financial statement, because the evidence is not available. So auditor is not very sure whether it has given rise to material misstatement or not given rise to the material misstatement, but the auditor is not able to form an opinion whether absence of those audit evidence will give rise to material misstatement in the financial statements. So if auditor is unable to form an opinion in lack of audit evidence, that they are not able to determine whether the financial statements give true and fair view, then also the auditor will modify the audit opinions. Now there are three types of modification. One is qualification, second is adverse, and third is basically disclaimer of opinion. Now let us understand in which scenario which kind of basically modification of opinion will trigger. So you have obtained audit evidence, you know that okay, in this particular area there is a material misstatement, and you are able to quantify the impact of those misstatement, but that misstatement is not pervasive to the financial statements. It does not impact many of the elements of the financial statements. It may impact only one or two elements in the financial statements, and even if it impact one or two elements of the financial statements, the proportion of that impact is not basically significant to the entire set of financial statements. So either you have identified misstatement which impact like revenue, it impact expenses, consequential impact on the profit. When you come to balance sheet also, it have impact on receivables, it have impact on net worth. So lot of items are getting impacted, and that impact is considered to be pervasive. Now it may happen that it may not impact many of the element. Means you have not identified many misstatements, you have identified only one misstatement in the financial. But the proportion of that misstatement is so basically significant that you cannot say that subject to this the financial statements give true and fair view. For example, if there is an impact in the revenue account, now that impact itself, the proportion is so large that your profit becomes into substantial losses, your net worth get eroded, and the receivable which is sitting in the balance sheet, if you consider the total size of the balance sheet, that misstatement is very, very material to the total balance sheet size. Even that case also, it is considered to be a pervasive effect. It could also be in terms of disclosure. So if the disclosure, which is very fundamental to understand the financial statements, and if those disclosures are not being made, then also it is considered to be pervasive. So the auditors have obtained all the evidence, identified misstatements. That misstatements are material but not pervasive, then the auditor will issue qualified opinion, and that qualified opinion will be quantified qualified opinion. So the auditor will clearly state that to what extent the financial statements are materially misstated. So in this scenario, quantified qualified opinion will be issued. If, as I said, that misstatement is pervasive to the financial statements, then the auditor will issue adverse opinion, because the impact of the qualification is so significant that the accounts does not give true and fair view. Qualified opinion, subject to this, the account give true and fair value opinion. Adverse means because of the significance of the qualification, pervasiveness of the qualification, pervasiveness of the material misstatements, the account does not give true and fair view. Now coming to another scenario whereby the auditor has not been able to obtain sufficient appropriate audit evidence, and the possible effect of lack of obtaining those evidences in view of the auditor, it is material but not pervasive. In that scenario also, the auditor will issue qualified opinion, but it will be unquantified qualified opinion. So the auditor would say that because of this lack of this evidence, this could be possible effect on the financial statement. However, the effect is not so pervasive, and hence subject to that the accounts give true and fair view. Now if the auditor is unable to obtain sufficient appropriate audit evidence, and that evidence is so pervasive to the entire set of financial statements that the auditor is unable to form an opinion whether the account will give true and fair view, in that case the auditor will give disclaimer of opinion. Now let us focus little bit more on the disclaimer of basically opinion, that under which circumstances the disclaimer of opinion situation may arise. So there could be three type of scenario where the auditor is not able to form an opinion. So one is that circumstances which are beyond the control of the management. Like for example, if basically books of accounts of the company is destroyed by fire or by flood, and those books of accounts are not available for auditors to verify, and hence the auditor is unable to give an opinion on the financial statement. Those are beyond the control of the management. The second circumstances could be because of the nature and timing of the audit procedures. Now when I say nature and timing of the audit procedures means, for example, the auditor is carrying out audit of consolidated financial statements. Now there is an investment in an associate. So the company is holding more than 20%, less than 50%, and hence the management company is having significant influence on another entity, and as per the auditing accounting standard, the management needs to basically do equity accounting for those investment in the consolidated financial statement. Now the associates financial statements are not basically available, and hence basically the auditor is unable to form an opinion whether the accounts give true and fair view. If it is like pervasive or proportion is very high, then again it's a disclaimer of opinion. If it's not very pervasive, then the auditor will give basically qualified opinion on the financial statements. Or maybe the timing of appointment of the auditor is such, the auditors are appointed subsequent to the year end, and hence the auditor is not able to physically verify the inventory, and the nature of inventory is such that it's not possible that auditor is able to draw comfort by performing certain alternative audit procedures, and hence because of that the auditor is unable to obtain sufficient appropriate audit evidence for the account balances which is subject to audit. Third scenario can be that the limitations have been put in by the management. So management is either not allowing auditor to carry out physical verification of inventory, or the management is not allowing the auditor to circulate the balance confirmation. So this is the limitation which is like put in by the management. And let me focus little bit more time on this third aspects where is limitation has been put in by the management, because there are other implications also of the limitation in the scope by the management. And there could be also fraud risk factor if the management is not allowing you to performing certain basically audit procedures. Now in this scenario, what the auditor should do? So first of all, the auditor should basically discuss with the management, asking them to removing this scope limitation and allowing them to perform the audit procedures which in view of the auditor is important to perform. If the management do not agree, then the auditor need to reach out to those charged with governance, like for example the audit committee, requesting them, explaining them that okay, there is a limitation which has been put in by the management, and see that if there are any alternative procedures which are possible. Even despite doing all these thing, if auditor is still not able to remove the limitation which is put in by the management, if it is permissible under the law and the auditor believe that this limitation is very pervasive to the financial statement, and the auditor is required to give a disclaimer of opinion, then first approach is always to withdraw from the engagement. If it is possible, permissible under the law, then basically the auditor may decide to resign from the audit, of course after taking due legal advice on this subject. Now the withdrawal from the audit engagement may also depend on the stage of audit. So like virtually if auditors have completed the most of the audit procedures which they have planned, and towards the basically conclusion stage, if there is a limitation which has been put in by the management, then the auditor may decide that okay, let us complete the audit and issue a disclaimer of opinion. Now let us understand that basically what kind of limitation could be there which is laid down by the regulation. So like for example, if auditor is appointed for public sector entity, then under those regulation the auditors basically are not permitted to resign. They need to complete the audit, issue a disclaimer of opinion, and then perhaps take a decision to withdraw or resign from the audit engagement. The other example is like listed entities, whereby as under the listing agreement there is a requirement that after the closure of the quarter, if there are any circumstances which arises which basically the auditor is not comfortable, even that scenario the auditor need to complete, if it is like not the last quarter, complete the limited review of that quarter before taking any decision to resign from the engagement. If it is like for last quarter, then they need to complete the audit and then perhaps take a call of resigning from the audit engagement. So as I said that there are three kind of modified opinion: qualified opinion, adverse opinion, and disclaimer of opinion. And there is a decision, I would say tree, which is there in the auditing standard, which guide the auditor that okay, what kind of modification is required to be basically issued in the given circumstance. Now let us understand the structure of the auditor's report. So the auditing standard does not give any particular order in which all the elements of the reporting requirements which is laid down in the standard is required to be given, except for two things, is that first para should always be opinion para, and the second para will be basis for opinion para. All other basically elements, it can be basically decided by the auditor in which order they want to basically give. In my view now, basically today the financial statement as well as the audit report has become so much bulky. It is very difficult to find out where is the opinion which is given. Maybe that is the reason, that is why basically the first para itself is opinion, so the reader understand what kind of opinion has been given. And the second requirement is to also use the appropriate heading. If you use the appropriate heading, then it is very easy for reader to identify if there are any unusual reporting which is done by the auditor which require the reader's attention. So the elements which are required to be given in the audit report, one is title. When we say title, it's like example independent auditor's report. Now independent auditor's report, if you give, it is very easy to differentiate the report which are issued by others. Like you would have also seen the report which is issued like independent practitioner's report, independent auditor's report. So when you say independent auditor's report, means that report is issued by auditors. If it is practitioner, that means that practitioner is not an auditor. To differentiate, basically it's very important that you give appropriate title of the report. The second important piece is addressee. So normally who is the addressee? It is normally governed by the law and regulations under which the audit report is issued, or it may be governed by the engagement letter. Generally addressee is either the shareholders or those charged of the governance for whom this report is prepared. So those are basically the direct addressee under the basically audit report. Then of course subtitle that this report is on what. For example, report on the audit of standalone financial statements or consolidated financial statements. Then opinion. Now when you, first para is opinion. When you give opinion, if it is a clean opinion, you will write only opinion. If it is a qualified opinion, it will be written as a qualified opinion. If it is adverse opinion, in the heading itself it will say adverse opinion. If it is a disclaimer of opinion, it will say disclaimer of opinion. So it's very easy for the users and readers to basically understand that what kind of opinion has been issued by the auditors. Then after that, it's a basis for opinion, basis for qualified opinion, basis for adverse opinion, basis for disclaimer of opinion. After that, of course, in the next session, the other eminent speaker will cover SA 570, which is material uncertainty related to going concern. So in the beginning, I showed you in the slide that okay, there are 6 reporting standards under 700 series, but those are not the only standard which we have a bearing on the auditor's report. There are other auditing standards also which could have impact in the auditor's report. So for example, SA 570. So if there are material uncertainty related to significant events or condition that may cast significant doubt on the ability of the entity to continue as a going concern, then the reporting requirement of SA 570 will follow. Another example could be SA 600, whereby the auditors are required to bring out division of responsibility for performing the audit of the financial statements of an entity in the auditor's report by indicating the extent of financial statements of a component which is audited by another auditor on which the reliance has been placed by the auditors. So there could be other auditing standards also which could have impact on the auditor's report. So these are the suggested basically the format and the content of the auditor report. There is also illustrative format which is given in the auditing standards, and the members are encouraged to follow those basically flow and the wordings. So SA 700 not only ensure consistency and comparability with other globally issued auditing standards, but it also basically have enough flexibility to accommodate the local requirements. So like for example, in India, we are also issuing report on internal control. We are issuing report on CARO. Apart from that, there are other basically reporting responsibilities which is laid down under the Companies Act. So SS 700 is like prepared in a manner which not only ensure comparability with the global auditing standards, but it also have enough flexibility to cover the local requirements. So like first is title, independent auditors report. Address is like, for example, members of so and so company. Report on the audit of financial statements. Opinion, qualified opinion, basis for opinion, material uncertainty para, emphasis of matter, key audit matter if it is for a listed entity. Not necessary that it's mandatory for listed entity for auditors to include key audit matters, but there could be also be scenario whereby the auditor may decide, even though if it is not mandatory, the auditor would like to include a key audit matter. Even in those scenario also, the requirements of SS 701 is required to be complied with. As we discussed that the auditor's responsibility is to read other information included in the annual report in accordance with SS 720. Responsibility for the preparation of the financial statement rests with the management, and the auditor is required to bring that out in the audit reports. We'll look at some of the aspects of responsibility of the management in our subsequent slide. Auditor's responsibility for audit of financial statements, that also we'll cover in the subsequent slide. Requirement of SS 706 for reporting on the other matters. If basically previous year financial statements audited by the predecessor auditors and that reference is not made in the financial statements by the management, that the previous year financial statements were audited by another predecessor auditors and they showed modified or unmodified opinion. If the management is not making that disclosure, then the auditor may choose to basically include that in its audit report to basically make it clear that the comparable periods have not been audited by them but were audited by predecessor auditor. Then if there are other local regulatory requirement, then that para can be covered subsequently with a separate heading. Of course, the audit report is in a written form and it has to be signed by the auditors, either physical or digitally. And if firm has been appointed as the auditor of an entity, then the audit report is to be signed in the personal name as well as in the name of the firm. There was a lot of confusion that the audit report is required to be signed in the personal name as well as in the name of the firm. And I know some of the firms were actually doing two signature, one in the personal name, one in the name of firm's name. But the institute has come out with an implementation guide which says that the auditor is required to sign the report in the personal name only. What does it mean is that they have to sign for and on behalf of the firm. So you have to write for so and so firm, personal name, and then sign in the personal name. And this is maybe one of the requirement that the name of the auditor is also required to be disclosed, the personal name. This is, I think, maybe to bring more transparency in terms of reporting that who is the individual who is taking the responsibility for issuing the audit report. The place of signing, which is generally the city in which the auditor has signed the report. It may be possible that the auditor is based out of one city, but the date on which the auditor is signing the report is based out of another city or maybe based out of another country. Then the auditor is required to write the place of signing. Then the date. Of course, the date cannot be earlier than the date before which the auditor have obtained all the audit evidences. Management has taken the responsibility for the financial statements. Management has approved and signed the financial statements. The audit report date cannot be prior to that date. And another thing, what this date indicate, which of course we'll cover in the subsequent session on the subsequent event. So the date of the audit report indicate to the users of the financial statements that the auditors have considered all the transactions and events which have taken place from the date of the financial statement till the date of signing, and they have considered that if those events or transactions have any impact on the financial statement, then those effect have been given. So that is the purpose of basically writing the date. Now what we will do is that we'll see that what is the normal form of audit report and how the form and content basically undergoes a change if there is a modification in the report. So starting with first para, which is like opinion para, unmodified opinion para. In that basically para, the auditor is required to basically identify the financial statements, each component of the financial statement. For example, balance sheet, profit and loss account, cash flow statements, significant accounting policy, explanatory statements. So they have to identify each of the components of the financial statements. Also the date and the period of the financial statements needs to be given. And if it is, as I said, that if it is a fair presentation statement, the auditor's opinion should state that the financial statement present fairly in all material respects or give true and fair view. So the term present fairly and true and fair, okay, both have same meaning. Auditor may decide whether they want to use present fairly or they want to use true and fair view. Globally, generally the wording which is used is that the financial statement present fairly. In India means we use like true and fair view, but both terminology has same meaning. If it is a compliance framework, then the auditor only state that the financial statements are prepared in all material respects in accordance with whichever is the framework which is used. The auditor does not say that whether it present fairly or it gives true and fair view. Now many times it may happen that the law and regulation prescribes the framework, and basically that is not maybe in view of the auditor, that if you follow that framework, the financial statement may not give true and fair view, okay, and hence it is very important for the auditors to highlight that fact. If that is the case, then the auditor is required to give emphasis of matter paragraph immediately after the opinion and basis for opinion paragraph, to highlight that okay, these financial statements are prepared in accordance with requirements of a particular law, but in view of the auditor that it may not give true and fair view in accordance with the generally general financial reporting framework. If you give unmodified opinion, then you cannot use certain wordings like with the foregoing explanation or subject to or in relation to the opinion. If you use those kind of wording, then basically actually you are not giving unmodified opinion, you are giving subjective opinion. And if there are any matter which has impact on the auditor's opinion, then the auditor cannot give unmodified opinion, and they will have to see the manner of reporting as per SA 705. Again, the important aspects here is that first the management needs to decide the framework under which financial statements are prepared, and they also need to give disclosures in the financial statements. Again, there they cannot use that the financial statements are prepared largely in accordance with the requirements of accounting standards prescribed under Companies Act or something else, because you cannot give such kind of limiting factor in the framework. When you say framework, you have to state that the accounts are prepared in accordance with the so and so framework which is prescribed. You cannot use any subjective terms while giving that kind of disclosure. Practically it may not be possible, but theoretically it may be possible that the management has prepared financial statements under two framework. One set of financial statements, but it is in compliance with two framework, like for example Ind AS and IFRS. And we all know that Ind AS and IFRS are similar frameworks. Of course there are certain carved out which is there under Ind AS. Some are optional, and it may still be possible that the financial statements which are prepared may be in compliance with both the framework. If that is the case, then of course the management wants to make their disclosures in the financial statements, that the financial statements are prepared under both the framework, then the both are the basically framework under which financial statements are prepared. Even when auditors give opinion in the para that okay, the financial statements prepared fairly in accordance with requirements of Ind AS and IFRS, even they are required to basically mention both the framework. But there should not be any kind of reconciliation between both the framework, and the financial statement should be in compliance with both the framework. Then only the auditor can issue unmodified opinion. Now if financial statement comply with one framework but does not comply with another framework, then the auditor will issue unmodified opinion in respect of one framework, whereas auditor will issue modified opinion for compliance with another set of framework. Now many times the management give that okay, the financial statements prepared under Ind AS, but they give some sort of reconciliation in the financial statements, reconciliation of the results and significant components in the financial statements with IFRS or US GAAP, and they include supplementary information in the financial statements. Now if that is the case, then the auditor will say that okay, it is in compliance with Ind AS, will not give any opinion in terms of compliance with basically other framework. Now these are basically integral part. The reconciliation which is given is an integral part of the financial statements, and hence it is the responsibility of the management, the auditor, to ensure that those disclosures are in compliance with the required framework from the numbers perspective. That reconciliation which is given does not give basically give true and fair view. There are no misstatements basically in the reconciliation which is given. Now if it is a qualified opinion, so this we have looked at the unmodified opinion. I kept unmodified opinion basically wording as it is, and I have only modified, just look at that how the content of the audit report undergoes a change if it is like a qualified opinion. So first thing, that the heading will change to qualified opinion, and in the opinion para basically in the previous, if it is a clean report, the auditor used to state that in our opinion financial statement give true and fair view in accordance with so and so framework. If it is a qualified opinion, the auditor would state that financial statements in our opinion, except for the effect or except for the possible effect of the matter described in the basis for qualified opinion section, the financial statements give true and fair view. And if it is compliance framework, again you will use except for the effect or possible effect, the financial statements are prepared in accordance with the requirements of so and so framework. Now here if you look at, I have used effects for their effects or possible effects. So if the auditor has identified a misstatement, they are able to quantify the misstatement, then the auditor will say except for the effect, the financial statements give true and fair view. If the auditor is not able to obtain sufficient appropriate audit evidence, and hence they are not able to determine the extent of misstatements in the financial statements, then the auditor will say except for the possible effects of the qualification which is stated in basis for qualified opinion, the accounts give true and fair view. Now coming to adverse opinion, again I have kept basically the clean report form and content intact and only modified that if the type of report undergoes a change, what kind of changes happens in the report. So since it's an adverse opinion means the misstatements are material and pervasive to the financial statement. The auditor states that because of the significance of the matters described in the basis for adverse opinion, the financial statement does not give true and fair view. So this is the adverse. When it comes to disclaimer of opinion, you can see like in the third bullet also there is modification. Here we say that okay, that the financial statements have been audited by us. If it is like clean report, if it is like qualified opinion or it's an adverse opinion, the auditor states that okay, auditors have carried out the audit of the financial statement. Whereas if it is a disclaimer of opinion, the auditor says that we were engaged to audit the financial statement. We actually do not state that okay, we have audited the financial statements because we have not got all the information which is required for the purpose of performing the audit, and hence there is again one more modification that we were engaged to audit as compared to basically we have audited the financial statements. And if you look at the opinion para, that we do not express an opinion on the financial statement because of significance of the matters described in the basis for qualified opinion report. We have not been able to obtain sufficient appropriate audit evidence to provide a basis for audit opinion on these financial statements. Now, when basically you issue adverse opinion or basically disclaimer of or mainly if it's a disclaimer of opinion, then you do not give any key audit matter apart from the matter which impact the basis for disclaimer of opinion, and you even do not give a para relating to other information SA 720 that the auditor has read and consider other information which is included in the annual report. Because if you try to give anything else in the audit report, then the users may basically misunderstand that reporting. They may believe that okay, the matter which is reported by the auditors apart from disclaimer of opinion, those matters are basically perfectly fine. But since you have not obtained the sufficient appropriate audit evidence, basically you have no basis to comment on any other information or on key audit matter. Of course, key audit matter, if it is mandated by regulation, then you are required to include. Currently, key audit matter is mandated by SA 701. It is not mandated by any regulations. In that scenario, you may miss you cannot give key audit matter in the audit report. If it is mandated by law and regulations, then only you will give key audit matters in the audit report if you are issuing a disclaimer of opinion. Now you have issued adverse opinion, you have issued a disclaimer of opinion, and you have identified the reason for giving those adverse or disclaimer of opinion. But you have come across other matters also, which otherwise you would have issued the basically qualified opinion on those matter. So the auditing standard says that okay, even if you have identified one key item which is sufficient to issue adverse opinion or disclaimer of opinion, but there are other matters also. So in that scenario, you have to also basically bring out other matters. Don't stop that okay, this matter is sufficient for me to issue adverse and disclaimer of opinion. तो अभी और क्या करना है, चलो हो गया काम. But if there are other matters also, it is the responsibility of the auditors to also bring that out in the auditor's report. Now the second para is basis for basically opinion which basically bring out that the audit has been conducted in accordance with standards on auditing. It refers to the auditor's responsibility section where in detail the auditor's responsibilities have been given. It includes a statement that the auditor is independent of the entity in accordance with Code of Ethics issued by the ICI, and if there are other requirements under, say for example, Companies Act or some other regulatory body, even those requires to be bring out. And then the auditor is required to state that they have obtained sufficient audit evidence to provide a basis for auditor's opinion. Now, many times it may happen that the law and regulations has prescribed the format and wordings of the auditor's report. So, if law and regulation prescribe the wordings and format of the auditor's report, if that regulation covers all the elements of the auditor's report which we had seen, okay, then only the auditor can refer that the audit has been conducted in accordance with standards of auditing. If this minimum information is not covered in the report format which is prescribed by the regulation, then the auditor cannot refer that the audit was conducted in accordance with standards on auditing. Now let us look at that how basically this basis for opinion undergoes a change if it is a qualified opinion. Everything else remains same except for the heading, that it's a qualified basis for qualified opinion, and the auditor has obtained sufficient appropriate audit evidence to provide a basis for qualified opinion. Here basis for auditor's opinion, here is basis for qualified opinion. Adverse opinion, everything remains same, heading undergoes change, and the basis, the auditor has obtained sufficient appropriate audit evidence to provide a basis for adverse opinion. Now look at disclaimer of opinion. Everything goes, you only state the reason for issuing basis for disclaimer of opinion. Here also you give basis for qualified opinion, adverse opinion, but you keep other normal para intact. But if it is a disclaimer of opinion, you only give the basis for disclaimer of opinion. You do not refer to that the audit has been conducted in accordance with standards on auditings and other aspects. Now we will quickly cover SA 706, emphasis of matter and other matter paragraph, which are considered as additional communication by the auditors. So if auditor believe that there are matters which are disclosed in the financial statements which are fundamental to the user's understanding of the financial statements, and those matters are not misstated. Okay, if it is misstated, then the requirement of SA 705 trigger, or if it is those matters are also covered by key audit matter, okay, then it will get covered under SA 701. So the matter which are fundamental to the understanding of the users, no modification of opinion is required, or no reporting or communication under SA 701 for key audit matter is required, then the auditor can issue EOM as per SA 706. If matters which is relevant to the understanding of the audit or auditor's report or auditor's responsibility, and if it is not prohibited by law or it is not covered by SA 701, then the auditor may choose to basically include other matter paragraph under SA 706. These are the responsibility of management and those charged with governance. So management takes the responsibility for preparation of the financial statements in accordance with the reporting framework. If it is a fair presentation framework, they need to say that it is their responsibility that the financial statements basically prepared to give fair presentation of the financial statements. They also take a responsibility to have appropriate internal control framework for preparation of the financial statements. They also take a responsibility to assess whether the going concern assumptions have been appropriately applied. These are the auditor's responsibility. So the auditor's responsibility para remains same if it is unmodified opinion, qualified opinion, or adverse of opinion. The auditor bring out the objective of the audit to obtain reasonable assurance whether financial statements are free from material misstatements and issue the report. Misstatements can arise from fraud or error. Auditor exercise professional judgment and professional skepticism. Risk of material misstatements, that the auditors have obtained sufficient appropriate audit evidence. Auditors have obtained understanding of internal control. Auditors evaluate whether the accounting policies are appropriate, the estimates are reasonable, conclusion on going concern is appropriate, and overall presentation structure and content of the financial statements are in accordance with reporting frameworks and give fair presentation. And the auditor's responsibility is to communicate audit plan, timing of the audit, significant auditing findings, significant deficiencies in the internal control, independence in accordance with code of ethics, and determination of key audit matter. Now when you come to disclaimer of opinion, basically no other responsibility under this para except that the auditor's responsibility is to conduct an audit of financial statements, and it says that because of the matter described in basis for disclaimer of opinion, the auditor was not able to obtain sufficient appropriate audit evidence to provide a basis for audit opinion. And it also confirms the independence in accordance with requirements of code of ethics. With that, I would conclude my presentation. Thank you for giving me an opportunity.
On behalf of WRC and everyone present here, I propose a vote of thanks to today's learned speaker, CA Manoj Dama, for giving a lecture on audit reporting standard SA 700, SA 705, SA 706 in a simple and practical manner with the example of structure of audit report with suggested contents. Now I request everybody to give him a round of applause. There will be a tea break of 15 minutes. We will come back.
तेच म्हणून बोललो ते म्हणून
हॅलो हॅलो अच्छा ऑफ कुठे ऑफ कुठे हॅलो हॅलो या हॅलो हॅलो या